And it feels like economists have been tripping over themselves to push back their recession calls. Maybe you're starting to see that priced out of the bond market, that recession trade. Are you still braced for a hard landing?
I'm still in the hard landing camp. I know we sort of have consensus around soft landing at this point, but I think the reality is that we've already landed. Core inflation is down to 3% plus. Core inflation minus shelter is down to 1%. So the reality, in my view, is that we've already landed, and that the Fed will do what it has historically done, which is wait too late to get started and then go too far. And I believe that they've already gone too far. Now we'll see what Mr. Powell says on Friday. We'll see what happens in September. But we've got $17 million of household debt. We've got trillion.
That's a lot.
17 trillion of household debt, 12 trillion of mortgage debt, 1.6 trillion of auto debt, $1 trillion plus of student debt, which, as we know, is going to have to start actually paying on that debt sometime soon. So we're a consumer-driven economy. I think we're in for a rough road ahead.
Speaking of the rough road ahead, you look at the 2-year, over at 5.04 nearly today, and you look at a 4.33 handle on the 10-year, and you think about the trajectory of rates and what else has to break as rates stay this elevated. Where has the market not yet seen pain that you expect?
Well, you were talking about the regional banking downgrade. I mean, we're very close to that. We've got a big real estate debt business and a big real estate equity business. On the debt side, we've got $1.5 trillion of maturities coming in the next 18 months. Obviously, that's going to be difficult to do in an illiquid environment. Regional banks are a big provider of capital, or historically have been. Now private credit is coming in, private equity is coming in and filling some of that gap. But the reality is there is a lot of mortgage debt that has to be refinanced, and those rates are a lot higher. And I can tell you that a lot of those Excel spreadsheets just don't work.
Well, what about the default rates here? Because you have seen a few defaults start to hit the market, but nothing so crazy yet. Do you expect that there's going to be significant distress? And frankly, you've made your name in some of this real estate distress. At what point do you find assets that are cheap enough to buy?
Well, it's true. I say I've lived through 88, 98, 08, and the pandemic, and so I've been through a number of different crises. I don't see capitulation yet. It is a lagging indicator. I mean, the issue is that you've got a 12-month lag on shelter really being factored into the inflationary dynamics. So, I think we're going to see capitulation and prices that are interesting, and private credit and real estate credit get very interesting from a buyer perspective later this year and into the first half of next year.